When an investor buys shares in a company, there's basically two ways to make money. The first one is called a capital gain. So that's when you buy the shares at a certain price and then the value of those shares go up. So that's the ideal situation for most investors. But that's only one of two ways that you can actually make money. The second way is through a dividend, and that's where the owners or shareholders get a share of the profits. Now, we call that drawings in Year 12 accounting, but basically what happens is during the year the business puts in a whole bunch of resources, so money, people, equipment, machinery, IT, knowledge and expertise. They put all those things into the company, and then at the end of the year it spits out a net profit. What's a little bit different than what we do in Year 12 accounting is that not all of the net profit goes to the owner. It depends on what the company wants to do. So the company might decide to reinvest half of that money back into the business, maybe buy some new equipment, buy another business. They also might decide to repay some debts, and they might decide to give a little bit as a dividend to the owner. So like I said, in Year 12 accounting, that's what we would call drawings. So how much of their net profit do companies pay out as dividends or drawings to the owners? Well, it all depends. Every business is different. So some businesses might pay like the example we just showed, so they paid a quarter of net profit. Another business might decide not to pay any dividends. They might decide to reinvest half the money back into the business and repay some of the debts with the other half. Another business might decide to repay some debt and then use half of the net profit to give to the owners as dividends. And another business might actually decide to give all of the net profit to the owners as dividends. So it totally depends on each business, but the point that we want to note is that whatever percentage goes to the owners out of the net profit is called the dividend payout ratio. So looking at business one, they've paid a quarter of their net profit back as dividends, so we'd say that's a 25% payout ratio. Business 2 didn't pay anything, so that's 0%. Business 3 paid half of their net profit, or 50%, and Business 4 would have what we would call a 100% payout ratio because all of the net profit went to the owners as dividends. Looking at BHP, it's a really good example of a company where you can make money by getting dividends. So over the last 5 years, the dividend's gone up for each share that you owned. You got a dividend of $1.01 in 2010-11. That went up to $1.12, then $1.14, then $1.21, and they announced that the 2015 dividend would be $1.24. So that you can see has increased every year, and in fact BHP have made it a policy to make that dividend go up every year since 1988. So you can see there's a lot of pressure on BHP to always have their dividend going up to their shareholders. So the share price over the last 5 years, you can see it's basically stayed about the same. There's been some good points, some bad points, but fundamentally BHP's shareholders have come to expect a dividend because that's a really good way to make money from BHP shares. You can see the shares have basically broken about even. So for a capital gain perspective, they haven't really made a lot of money that way. But if you've got that dividend every year, you've made quite a bit of money over the last 5 years. Here's an interesting thing to look at is how much they pay in total dividends or drawings. So in 2010-11, they paid $5.1 billion in drawings. And we want to check as a sort of ratio how much of the net profit was that. Well, net profit that year was $23.6 billion. So you can see drawings is only just a small fraction of total net profit, and that leaves this other part of net profit to repay debt, reinvest in the business, buy other things. So they're not using a whole lot of their net profit as drawings. In 2011-12, the dividends went up to $5.9 billion. We'd expect that because they said their policy is to increase dividends every year. Net profit was only 15.4%, so it wasn't as much. It was still much more than the dividend though. 2012-13, dividends went up to $6.2 billion. Net profit was 11.2, so it's getting closer and closer to being more of the net profit. 2013-14, again, dividends went up just slightly to $6.4 billion and net profit went up to 13.8. And then we get to this year where we've got a bit of a problem. They've announced their dividend of $1.24 per share. That's going to be total drawings of $6.5 billion. And that's okay as long as your net profit is going to be bigger and bigger every year. But in this year, the net profit was only $1.9 billion. So we've actually got a situation where they're going to take out more in drawings than they're actually going to make in net profit. So now we need to ask, well, where does the money come from? So looking at this payout ratio, it was 21% of net profit in 2011, 38% in 2012, 55% in 2013, 46% in 2014, and in 2015 it's actually a payout ratio of 340%. So obviously it's 3.4 times the actual net profit. So what we need to figure out is, well, there's $4.6 billion unaccounted for there. Where are they going to get the money from? And can other payments still be made if they actually go and get that $4.6 billion? Because dividends or drawings aren't the only thing a business needs to pay. They want to try and reinvest in the business, they want to repay debts, and they want to buy other businesses. So if they get this extra $4.6 billion of drawings, maybe that comes at the expense of those other things. I think the question we want to ask is, well, should BHP even pay a dividend or drawings this year? If we were looking at this business in Year 12 accounting and we saw drawings 3.4 times higher than net profit, our advice would probably be, well, don't take drawings this year. But for BHP, maybe that's not an option, or maybe they could just decrease or stop increasing the amount of the drawings or dividends each year. However, some experts have come out and said, well, I think the best advice they should do, or they could follow, is to halve their dividend and abandon their so-called progressive dividend policy. What that means is the policy where the dividend is guaranteed to go up each year. That's the view of Credit Suisse analysis Paul McTaggart. He said that at these earnings levels, which earnings is what's called net profit, that's the term used on the share market, at this net profit level, it's not possible for BHP to sustain the dividend at its current level of $1.24 a share. So his advice was to halve the dividend. However, here's the problem. Here's the share price in the last 6 months. It's absolutely crashed. It's gone from over $26, $27 down to about $16.50, around there somewhere. And the problem there is, well, if I'm buying shares in BHP, there's the announcement. You can see it was a bit of an immediate crash. It did recover, but now it's gone all the way down. If I'm an investor in BHP shares, how do I make my money? Well, one is capital gain. Well, we can see there's not a gain. There's actually a loss. So if I'm an investor in BHP, the only way for me to make money now is that dividend. So if the company says we're not going to give a dividend, or we're going to cut it, well, the share price is probably going to crash even more, and they're going to have a lot of unhappy owners because there's little drawings coming out and nobody's making money from the capital gain. So here's their plan. So the chairman, Jack Nasser, came out and said, we're going to consider taking on debt in the short run to cover our policy of increasing dividend payouts each year. Over a short period of time, so he thinks it's just a short-term solution, we'll consider borrowing to cover the drawings or dividends, but if it risks the balance sheet over the long cycle, we will not do it. Nasser said this at the annual general meeting of shareholders. So that's basically what he stood up and told all of the owners or shareholders. You will get your dividend this year, but we will probably have to take on some debt to do it. So let's have a look at their balance sheet. So we know a balance sheet has assets on the left. We know that equals accounting equation style, the liabilities plus owner's equity. So let's have a look at BHP's accounting equation in the last 5 years. We can see assets, 102.9 billion, liabilities 45.1, owner's equity 57.8, and each year it's sort of gone up for the assets until 2015. So looking at that, the assets got up to as high as 151 billion, but fell a bit in 2015. Debts have increased from 45 to 54. However, that 54 is a decrease from the year before. And the owner's equity has gone up. So if I'm a shareholder, I'm glad it's gone up from 57.8 to 70.6. But it was a lot higher. It got up to as high as 85 billion in 2014. Now those numbers are good, but they're kind of useless. What we want is a ratio, because we need ratios to compare this to other businesses. So we want the debt ratio or gearing, and it looks at, are our assets financed with external funds or internal funds? So either liabilities or owner's equity, and it's a very simple ratio. So let's just plug in some pretend numbers. If total liabilities were 132.9 and total assets were 560.2, that'd be a ratio of 24%. What does that mean? It means 24% of the firm's total assets have been financed with external funds rather than internal funds. So under our balance sheet, for every dollar of assets, there'd be 24 cents of liabilities and 76 cents of owner's equity. So looking at their debt ratio over the last 5 years, it's gone from 44% for BHP to 48, so that got worse, stayed about 48, down to 44 and down to 43, so their debt is actually the best it's been in 5 years. What does the 43% mean? It means that for every dollar of assets, there's 43 cents of liabilities and 57 cents of owner's equity. So that liabilities figure is getting very close to the owner's equity number, so we wouldn't like that to go up anymore. So debt, when they come out and say we're going to borrow for these drawings or dividends, that's only going to make the debt worse. Well, let's have a look at how worse. If they go and borrow that $4.6 billion extra that they need, there's the current accounting equation in 2015. So let's figure out what would happen if step one, they went and borrowed $4.6 billion. Well, first of all, they'd have more money, so they get cash, so that's going to make our assets go up. However, it's also going to make our liabilities go up, and that's because we'll have a loan that we need to repay to the bank, and that'll increase $4.6 billion. Step two would be we then pay the drawings or the dividends to the owners. So the cash goes out the door, so assets go down, and we know from U12 accounting when we pay drawings, our owner's equity decreases. So that's what would happen. So let's add those numbers up now and figure out the new accounting equation. So if we did that, assets would stay the same. They went up and down by 4.6 billion, so that stays at 124.6. Liabilities go up to 58.6, and owner's equity goes down to 66. So let's get that as a ratio. So we'll plug those new numbers into our gearing ratio. We get $58.6 billion of liabilities, 124.6 billion of assets. That's going to be a debt ratio of 47%. So that's going to go up to from 43 to 47, and that's about as high as it's ever been in the last 5 years. So this wouldn't really be a good idea from a debt perspective. So some questions to answer now that with your Year 12 accounting knowledge is, why are BHP increasing their dividend to shareholders each year? Financially, it doesn't seem to make any sense. So why are they doing it? Given their net profit for 2015, why is paying that dividend going to cause such a problem? What impact will borrowing the extra $4.6 billion needed to pay the dividend have on the company's debts? So you can talk about the gearing ratio and have some concrete evidence of what that'll do to their debt levels. And if you were running BHP, should you stop paying the dividends or simply decrease the dividend amount to each shareholder?